Okay, welcome to Financial Accounting. Once again, today we want to look at preparation of financial statements, and we are building on to our knowledge that one we had in the previous recordings. In case you have not gone through the first recording of preparation of financial statements, then you can be able to go through that so it can help you get a picture. So I'm going to use tools. I'm going to use that question, but I'm also going to first give you a brief on what we are basically doing. So like I said, we are preparing financial statements. Prepare financial statements. Now, you get to realize that most of the questions that you come to interface with in the exam are questions that are around preparation of financial statements. But then the preparation of financial statements, one, you need to know the financial statements themselves. But then you also need to understand the different business nature that we deal with. Now, the reason why you also need to appreciate the nature of the business is because different businesses also have different ways of how they prepare their financial statements. But the key financial statements that we know is we know very well that we have the statement of financial position. We have the statement of financial position. We have the statement of what you might call comprehensive income. Then we have the statement of changes in equity. And then the statement of cash flow. So these are the key statements that we have. So I just spoke about the business nature because I said we have limited liability companies. Then we have the partnership businesses. And then we have the sole proprietorship. Now, as you know very well that people who are in sole proprietorship, for them, in most cases, they don't have accountants. So most of the accounts is the way it is there. Then we have, we could have public or not only public, because limited liability can be public and private, but then you can also have manufacturing and have manufacturing companies. Now, these ones also prepare their financial statements a little uniquely because of inventory that they carry. So you need to understand the formats of each of these financial statements, which is partly what is in the previous videos, so that you can easily prepare these financial statements. So in most cases, remember what we talked about when it came to what you call your accounting process. We usually have what we call an accounting process. And we say that through our accounting process, after we've started from a transaction, okay, from a transaction, we say that transactions go and enter what you call books of original entry. And then from books of original entry, which are also called books of prime entry, these ones go to ledgers, okay? Basically go to ledgers, and from ledgers, we balance off and go to our trial balance. And then we now prepare our financial statements. So in most cases, you'll find that the examiner will bring you already a prepared trial balance. And in that trial balance, they want you to prepare the respective financial statements. So that is why in this case. So it means they have already done the other work for you. That is why when you get to such a question, already you have a trial balance that has been prepared for you, and then you have now to do the financial statements. So for this question, as we can see, they are telling us that Kirungi Limited has the following information for their end at 31st December 2020. And this is their trial balance, basically. So it all starts with, net profit of 905,000. This is net profit of 905,000. And then it goes ahead to give you retained profits as at 1st January 2020. Now, before I even look so much in the details of this question, let's first look at and see what does the question actually require of us. What does the question require of us? The question requires us to prepare adjusted profit. It also requires us to do the statement of changes in equity, and it also requires us to do the statement of financial position. Now, a bit different from other questions, because most questions will ask you to prepare a statement of profit and loss. But this question is asking you to prepare adjusted profit. So in this case, the reason why they're asking for adjusted profit, because even in the question itself, they have already given you what? They have already given you a net profit. So there's already a net profit being provided for you, which has been used to calculate, basically it's the result of some of other transactions that have been tried to get here. So this is one case of scenario. So let's just go through this and then we can see if we need to do this, or we can start with one where we don't have the net profit because before you can get here. So this is a question, as you can see, we have net profit. Now you can see from your trial balance, you get to realize that there are two columns. There is a debit column and then there's a credit column. Now it's very intentional that we can see that our net profit there is on the credit side. Net profit is like income, it's net income. Net profit has a normal credit balance, okay? Net profit has a normal credit balance. If it was a loss, it would be on the debit. So it's very good for you to understand and be able to interpret these figures as they appear. So we have net profit and then we have retained profits. So we understand that net profit and retained profits are totally two different things. Of course, net profit is the profit for the year, while retained profits is including profits for the previous years. So the other word for retained profits is retained earnings. Some other people may also call it accumulated profits. So when you're given this figure as at 1st January 2020, they're giving you 87,540,000, means that that is the profit that the business has earned from previous years to 1st January 2020. So it also has a normal credit balance. As we can see it there, it is on the credit. We also have cash and bank. So cash and bank are assets, as we can see here, and the balance they have is on the debit side, which is 1130. And then we have inventory as at 31st December 2020. Now, from the look of things, you can see that the year end for this organization is ending 31st December 2020. So if we have inventory as at 31st December 2020, means that this is their closing inventory. This is their closing inventory. So we also need to understand, where do we use closing inventory when we are preparing financial statements? Now you have to understand that inventory is an asset and it is a current asset. So when you are preparing your financial statements, inventory is recorded under your statement of financial position as a current asset. But also inventory is taken to the statement of comprehensive income and it is deducted while we are preparing when we are calculating our cost of sales. Because after we have sales, then we do less cost of sales. It is under that cost of sales where we say opening stock, add purchases, and less closing stock. So closing inventory goes in two places, goes into the statement of financial position, but also goes into the statement of comprehensive income. So it's good to appreciate that. And also to say that trade payables, as we can see, we have been given a 100,357. Where do we use trade payables? We know very well that we use trade payables in the statement of financial position, where we are looking at our current liabilities. And then we have investments. Investments is 1.656760. Which investment? Now, in this case, this is basically, what can I say? Businesses also have investments in other organizations, or they could be in other organizations, or they could also invest in let's say, government securities. So this is investment. As you can see, it is an asset. Usually we classify investments under non-current assets because we presume that these are long-term and the company will be able to benefit for them within a period even beyond 12 months. So that is very key for us to understand. So that's why you can even see investments have a debit balance because they are assets. So this will be recorded in the statement of financial position. Then we have allowance for bad debts. Now, allowance for bad debts is also called provision for bad debts. Allowance for bad debts is also another word to mean provision for bad debts. So we are seeing that we have a value of 42,380. So if it is 42,380, what does this mean? Why do we have provisions? Organizations, because they work with what we call debtors, the people that we sell to on credit. We believe that not whoever we sell to actually will meet their payment. And that is why we bring in now a provision. So we provide for the people that may not pay us. And that's why it's called a provision for bad debt. Bad debt is somebody who fails to meet their obligation, their debt obligation. So an allowance for bad debt is basically trying to set money aside to say, in case someone does not pay me, at least this is something that I've set aside. So that's why we call an allowance for bad debt. So that's why we are seeing it on the credit side. Now, also you need to understand that provision for bad debts is different from bad debts. Provision for bad debts is different from bad debts. You can have bad debts as provided, but a bad debt is an expense already. Provision for bad debts has a normal credit balance and it is deducted in your statement of financial position. We deduct this value from our receivables unless there's an adjustment. If not, we deduct this money from our receivables. Well, bad debts go to the statement of profit and loss. Now, some of these things that I'm saying may not seem to make much sense for you if you have not gone through any of the previous videos, okay? If you have not gone through the previous videos, these things may not make much sense for you. So you need to make sure that you have gone through those videos so that you can easily acquaint yourself. And going forward, we need to make sure that we have gone through them so that we move at the same pace. So then we have share capital. So share capital, we are seeing that share capital is at 1,000 shillings. Share capital is basically is what you know as capital, owner's contribution to the business. So here they are telling us that share capital is worth 1,000. Okay, each share is at 1,000 shillings, and this adds up to 1,145,151. Share premium, they're telling us is 475,506. 475,506. So what does this mean? Now, share capital and share premium are a bit similar to each other, okay? Are a bit similar to each other, and I just want to explain to you what share premium might be and what share capital is. So share premium arises well when shares are issued at a premium. Shares are issued at a premium. And what does this mean, shares being issued at a premium? Now, from our question, we call it nominal value. So the nominal value of our shares is how much? The nominal value of our shares is 1,000. So what can happen? What can happen is that the company can actually issue shares above the nominal value. So the company can issue shares, we call it issue price. So they can issue, instead of 1,000, they can issue this share at 1,200. They can issue these shares at 1,200. So you can see that the nominal value is 1,000, but they issue the shares at 1,200. So what does that mean? It means that shares have been issued at nominal value. So we have even this same scenario that we have here. When you proceed down in this question, you get to realize that there was an issue of shares. Let's just see down here. I don't know if we have an issue of shares here in the question. I don't know if it's there, but if it's not there, then yeah, we can just try to learn and see. Okay, actually it is it here? Okay, it's not there. Maybe we can just try to continue learning this. So what I was saying, that if your normal value of a share, a single share, is 1,000 and you issue shares at 1,200, means that you've issued them at a premium. So the premium value will be 200 per share. Just the difference between 1,000 and 1,200 will be the value of your premium. So what happens if you issue, let's say 200 shares? If you issue 200 shares, means that it will be, if I want to get, because usually when we issue shares, we have to distribute between what is share capital and what is share premium, okay? So your share capital, your so-called share capital, will always be what? Your share capital will always be the number of shares, always be the number of shares multiplied by, okay, number of shares multiplied by the nominal value. So share capital here will be the 200 multiplied by the 1,000. So share capital in itself will be, when you're getting here, times 1,000, this gives you 200,000. That's what you have as your share capital. But since you issued shares at 1,200, you have also what we call share premium. So you have to also calculate share premium. Now, share premium will be the number of shares times the difference between issue price minus nominal value. So this is, it will be, you look at 200 times what? Times bracket, the 1,200 minus the 1,000. So that is how you get your what? That's how you get your share premium. Okay. So if I'm just to make a calculation here, 200 times this, 1,000 minus that. So our share premium is worth how much? 40. So you get to realize that when companies issue, for example, if they issue 200 shares at 1,200, they're actually going to make 240,000. But as you can see, the 240,000 is distributed in two versions. We have a portion that relates to your share capital, and then we have a portion that relates to our share premium. Okay, so that is very important for us to understand. So that is why when you see both share capital and share premium have a normal credit balance, they basically work along each other. So that's why we are seeing we have a share capital value here, and then we also have share premium. So that is how share premium and share capital work. We will learn more ahead even as we proceed, and we shall understand more, but that should give you an insight when you see something to do with share premium. So trade receivables is another item. Trade receivables are assets, and they are current assets. Trade receivables is another word for debtors. And what we mean by debtors here are people that you've sold to on credit. So they have given us this figure, and it's not surprising that it's on the debit side because trade receivables are assets, and assets have a normal debit balance. So that's why we are seeing it here. Then we have what we call revaluation reserve. And they're telling us revaluation reserve as at 1st January 2020. So this is 76,540. Now, what are revaluation reserves? Revaluation reserves are usually reserves that represent increment in the value of the assets due to revaluation. Reserves that reflect the increment in assets due to revaluation. Now, businesses hold assets, and by assets, I mean they have motor vehicles, especially non-current assets. They have, let's say, land, they have, let's say, machinery. So let me give you an example. So today you have a machine. Let me use maybe land, it would be even much easier for you. So land, you bought it at 2 million 5 years back, but that land has appreciated. And it's no longer 2 million, but now it is worth 20 million. Now, because of what we call the historical concept in accounting, which requires us to record transactions at the cost at which we bought them, you find that that land on somebody's balance sheet is showing 2 million, but when in reality, that land is worth 20 million. So to remove those variances, we have what we call revaluation. So we revalue our assets to make sure that the value we represent them on the balance sheet or statement of financial position depicts the actual value they are in reality. So that is very important, that when you see land worth 2 million, it should be valued really at 2 million when you visit the land. Okay, so not because at the end of the day, there are several people that make decisions on the financial statements. Some of these people may be banks that want to give you loans. So they really want to get a true picture of what assets you have. So you are required to revalue assets as and when it is you feel it is needed. The same thing also happens for machinery or motor vehicles. Sometimes because we have depreciation, we may depreciate our assets to even nearly maybe 100,000. So you find that this motor vehicle is really working, it's on the road, but when you look at the books of accounts, this motor vehicle is worth 100,000. Like from depreciation perspective, this vehicle has been depreciated and it is now 100,000. So because this vehicle is still moving and is on the road, you're supposed to revalue it. So the difference between the cost of your vehicle, for example, you have your vehicle at, let's say, at 100,000 as per your depreciation, and now you're revaluing it back to, let's say, to 5 million. The difference there forms the revaluation reserve, which you take to revaluation. Now, revaluation reserve is an item of equity. And by item of equity, I mean when we are drawing up our statement of financial position, after we have recorded retained earnings and share capital, we also record revaluation. So revaluation, that's why you're seeing it has a normal credit balance. It's also an item of equity. And even when we are drawing up our what we call our statement of changes in equity, revaluation reserves will also go to the statement of changes in equity because it's an equity item. So I just wanted to give you an explanation of how revaluation comes. It's more to do with revaluation of non-current assets. So we have land at cost worth 420. Now land is another asset that a business can have, and this is recorded under non-current assets. Land does not depreciate. It's the only asset that doesn't depreciate. So they gave us the cost, and that is the value we shall have. Then we have motor vehicle at cost, as we can see, it is 2030 504. So they told us that accumulated depreciation as at 1st January 2020 for motor vehicle, because motor vehicles depreciate, is 115,252. So because motor vehicles depreciate, this 115,252 is the depreciation for this asset for the previous years, because they have said this is the actual depreciation as at 1st January 2020. Remember, these books that we are looking at are for the period ended 31st December 2020. So they are basically telling you that at the start of the year, this is the accumulated depreciation that you're starting with. 115,252, computers 16,350, plant and machinery 103,695. So this is the accumulated depreciation. Now, accumulated depreciation, sometimes they may call it allowance for depreciation. Maybe you can note that so that you can remember. Allowance for depreciation. So if the examiner, instead of calling it accumulated depreciation, call it for allowance for depreciation, they would still be meaning the same thing. Okay. So that is very important. So given that we have this question and we are preparing books of accounts for the period ended 31st December, means that along the way we are going to calculate our depreciation, and whatever depreciation we get, we have to add it on our accumulated depreciation in order to get the accumulated depreciation as at 31st December 2020. And that is the accumulated depreciation that we deduct from the value of the cost of our asset to determine what? To determine the net book value of the asset. Okay? Net book value can also be called carrying amount. Okay? So we'll be able to use those words for currently. And then we also have a computer at cost. Computer at cost is 65,400, as you can see. Whenever they say at cost, this is the value at which they bought the computer. But remember, we also have the accumulated depreciation, which represents to what extent this computer has depreciated. So continuously, they also give us plant and machinery at cost right there and its respective depreciation. Then they also give us what we call dividends paid. Dividends paid, what these represent, businesses, especially corporate entities, have shareholders in them, and the return to shareholders is dividends. So dividends are deducted from profits. We pay dividends off the profits, okay? So that is very important for you to know. Dividends are not expenses, okay? Dividends are not expenses. Rather, dividends are items of equity. So if you want to look at dividends and their effect, what we basically do is we do that when we are doing our statement of changes in equity. And then we have that saying 18% loan repayable by 2027. And this value is 300,000. So this is a non-current liability because it's a loan that is repayable by 2027, which is a period beyond 12 months. So this is supposed to be recorded under your non-current liabilities. But as we can see, this loan comes with a percentage at the start, 18% loan. This 18% means that the 18% is the interest on the loan. So ideally, one or the other, if this loan was gotten within this year, okay? And we have not yet done interest. We will calculate interest along the way. So the question goes on to say additional information. The senior accountant of Kirungi Limited was on annual leave. The assistant accountant determined the net profit that is within here. So what they are trying to mean is that the senior, basically the so-called is it junior accountant, this assistant accountant prepared a statement of comprehensive income and got this profit, because it is the statement of comprehensive income that gives you the profit. So they got this profit, but then they are telling you that, but had not taken into consideration the following items. So these are the items that were not taken into consideration. So they are telling us that the amount of inventory at 31st December 2020 of shillings 45,507,000 was used in determining the cost of sales. Further information revealed that part of the inventory that had cost 6.7 million had a net realizable value of 4.5. Now, this is additional information, and additional information, in most cases, the one that now looks at the end of year adjustments that we have to make. So they're telling us the assistant accountant did take into consideration these issues, maybe because they were not aware on how to handle them. So what do we then do with this additional information? Remember, the question is asking you to prepare the adjusted profit. They want you to prepare the statement of changes in equity, and then they also want to prepare the statement of financial position. So what we are going to basically do here is look at the impact of each of these transactions. So they are telling us that the amount of inventory as at 31st December 2020 of shillings 45,507 was used in determining the cost of sales. Further information revealed that part of the inventory that had cost 6.7 had net realizable value of 4.5. Now, one of the things that you need to know, and you can write this in case you have a notebook, is that inventory as per IS2, as per International Accounting Standards 2, should be valued. Inventory as per IS2 should be valued at the lower of cost and net realizable value. Inventory as per IS2 should be valued at the lower of cost and net realizable value. Now I want again you to listen here. The reason why we value inventory at the lower of cost and net realizable value is because we are not sure whether inventory will be sold or not. So we cannot value it any value that is above between what we can between what we can get it from the market in terms of the return from the market. I'll give you an example. Today you might have, let's say, you deal in maybe let me say you deal in funds. So you have funds worth 200,000 based on cost. Maybe that's what you bought them. But along the way, you know, funds keep on getting off the market because there are new versions of funds that come up. So you end up valuing your funds based on how much you invested in them. But in reality, when you go to sell those funds, because they are off market, people can only give you 150,000, or they can only give you 100,000. So the principle here says that we should not value inventory on the cost that we incurred in acquiring them, but we should look at as well what we can get from the market, which is the net realizable value. And net realizable value, if you want to get the net realizable value, is the selling price, basically, what you can sell that stock or inventory in the market, less the costs to sell. Net realizable value is equal to the selling price less cost to sell, less cost to sell. What cost to sell means basically is when you're going to sell that phone, you're going to incur some costs like transport or like advertising. So when you get how much they can pay, let's say they can pay 150,000 and remove 5,000 transport to deliver that phone, the difference you get is the net realizable value. That's why they call it net realizable. They would have told you realizable value, but they're calling it net realizable value because part of that amount is incurred while you're trying to sell the product. That's why it is called a net realizable value. So it is that 145 that we compare with how much we incurred in buying that inventory. So it's the same thing here where they're telling us that as at 31st December, this inventory of 45,507, okay, which we have here, this inventory in our trial balance, they're telling us that this inventory has a certain inventory, okay? Part of that inventory includes an inventory that had a cost of 6.7 and had a net realizable value of 4.5. So if this is the case, this inventory needed to be valued at what? At 4.5 rather 6.7. Why? The principle says that we should value inventory at the lower of cost and net realizable value. So we should value this inventory at 4.5. So if they valued it at 6.7 means that that was not right. So we have to make an adjustment to get the true value of our inventory. Okay. So since we have, okay, somebody has raised a hand, Emmanuel, you can unmute and ask if I can proceed.
I was just inquiring because if I used 6.7 million to buy my stock, the inventory, when I'm making my statement, aren't I supposed to use the amount I used in buying my stock?
Okay, so that is his question. And like what I said we have a standard, a full standard that regulates how we recognize, measure inventory. So the standard says that closing inventory should be valued at the lower of cost and net realizable value. So if what the two things that you need at hand is your cost and net realizable value. So you get your 6.7 and compare it with your 4.5 and ask yourself which one is lower than the other. The one that is lower is the one that you proceed with. So in this case, even if our net realizable value was 4.5 and our cost was 3.2, would have gone with the 3.2. So that is the principle and it's a standard that we proceed with. So you cannot value your inventory at cost when your net realizable value is lower. You only value it at cost in case your net realizable value was higher. So you have to compare the two things. So this inventory that is worth 6.7 should actually be valued at 4.5. So if you have this inventory and they're telling you that it's embedded within this inventory, so what we shall basically do is we shall get this figure. What we can just do here, maybe I can demonstrate it here. So I can say my current value of inventory. So this is the current value of inventory. So this is what I have. But included here is inventory. What they have told us 6.7, that should be at 4.5. So what I'll basically do, this is what I do. Remember, we have to adjust. Inventory should be valued at 4.5, but it was valued at 6.7. So for me, what I will do is I'll say the cost of that inventory that needs to be adjusted is how much? 6.7, which is 700,000. Like that. And then we have cost, and then we have our net realizable value of 4.5. So that is what we basically have. So what we are going to do here, what I will do is I will remove this 6.7 and add up the 4.5. Okay. So this will give me which value? When I try to do this, I'm just trying to use my Excel. So this inventory, instead of being valued at 4.45, okay, instead of being at 45, it should actually be at 43. So I've basically I've just changed the inventory value, which had 6.7. I removed it and put it 4.5. You can either do this, or what you can basically do, you can get this 45 and just adjust it with the difference between 6.7 and 4.5. Okay. When you get the difference between 6.7 and 4.5, when you press your calculator, you get realized that 6.7, 4.5, that is about 2.2. Yes. So 2.2 is the difference. And that 2.2 is the extra amount they included in inventory, which is going to be there. So that is why that is adjusted of your inventory. So even when you subtract it, you still get to what I think. So whatever works for you. So this will be the value of your closing inventory that you should take to your respective books, either P&L or take it to the statement of financial position. This should be your value of inventory because you have adjusted this inventory to meet the standard, which is IS2, like I said, and I asked you to note that because in most cases, the examiner always want to test this area to make sure that you understand the dynamics of inventory and its valuation. So that is about this. So then they also talked about something here. They said purchase returns of 4.5 to a credit supplier were not accounted for. Now, what are purchase returns? Purchase returns are usually when you purchase goods from a supplier, you may be uncomfortable with some goods and return them. So that we call purchase returns. Your question should be, how do purchase returns affect your profit? Okay, how do purchase returns affect my profit? Now, we should remember that when we are preparing our so-called statement of comprehensive income, we say that we start with sales, okay? You start with sales, and then we have less cost of sales, okay? Now, less cost of sales, remember, even before the cost of sales, let me just put something here so you don't forget. Remember, we have what we call sales returns, okay? And these sales returns are also called return inwards. It's good for you to know how those words can be used concurrently. So we have return inwards. So return inwards, these ones, when you remove them from sales, you get your net sales. You get your net sales right there. So that's how you do it with that. So after that, we do less cost of sales. Now, when we less cost of sales, how do we calculate cost of sales is we start with what? We start with opening stock. We start with opening stock. Opening stock, we add purchases. We add purchases. Now, purchases have adjustments to them. Just like the way we adjusted sales returns on sales, purchases also have an adjustment to them. So we can adjust our purchases with what? With purchase returns. So we can less purchase returns from our purchases. Purchase returns are also called return outwards. The examiner may call it return outwards this time. So you have to have that in mind. Return outwards, okay? So this should be in bracket actually, because it's being deducted. Sorry. So I believe that you know that apart from purchase returns, the other adjustment that we can add on to our purchases is carriage inwards. Carriage inwards are added here as well. Carriage inwards is basically logistical expenses that are incurred in bringing goods to the premises. Carriage inwards can be adjusted, can be added to our purchase returns, okay? We also have what we call carriage outwards. Those are usually related to sales, but for these, they don't adjust the sales. Carriage outwards should be taken to your expenses, okay? Carriage outwards should be taken to your expenses. And then after you've had this, you can get your net purchases, okay? Which is basically the you add these figures together, okay? Maybe this can be here, not confuse you. So you can get your net purchases, which can actually be here, okay? So your net purchases, and then after you have your net purchases there, you now have less closing stock. Less closing stock. Which closing stock? We have already calculated. So this is just a simple format to show you how some of these things might actually be, okay? This is how it actually is. So once you have your closing stock, what I wanted to demonstrate to you was how purchases work and the effect of purchase returns on your purchases, which is represented here. So if the question is telling us that there were some purchase returns that were not recorded, because when you come to the question here, they're telling you that purchase returns of 4.5 to credit supplier were not accounted for. So this has an effect on your profits, means that ideally your profits are missing something. Basically your profits are being overstated or understated based on what we are going to see as we proceed. So that's the effect of purchase returns for now, just to give you that insight. We're going to see how we can apply that, okay? I just want let's first get an understanding of what we have in additional information, and we can see what the documents that we are going to prepare. So then they are telling us that interim dividends of 90, 50, 450 reflected in the trial balance were paid on 3rd of October 2020. Interim dividends that we are seeing in the trial balance, these ones were paid on October 2020. So they were paid within the year. As you can see, our year ends on 31st December. So these were paid within there. So these are valid for recognition. But then they're also telling us that Directors further proposed a final dividends of 70 per share on 20th December 2020, which is subject to resolution at the annual general meeting in May 2021. Now, this is a proposed dividend, okay? Now, proposed dividends should not be, they don't affect our statement of changes in equity. Rather, we should make a declaration. We should disclose. We should basically disclose about these dividends, because remember, they are subject to a resolution that will happen after the period of year end, because our financial year ends when? Our financial year ends 31st December 2020. So by the time we get to May, it's a totally another period. So we are preparing financial statements for period ending 31st December 2020, then we've not yet made the resolution. So this should not affect our accounts. Rather, we should just have a disclosure that is made on them. Then they're also telling you that at 31st December 2020, salaries and utilities of shillings 12.5 and 607 respectively were outstanding. What does this mean to you? This means that our salaries and utilities worth those amounts were not paid. Okay? Salaries and utilities of that much were not what? Were not paid. So what this means is that we should go ahead to recognize, to accrue. We call it accruing. So these are accruals that should be recognized within our books. Okay? And we know very well that how we accrue expenses, you debit the expense. For example, salaries, you debit the salaries expense because salaries have a normal debit balance, and you credit your accrued salaries. And utilities the same way. The reason why we do the accrual is because these expenses relate to the financial year, but they were not paid. So for us to recognize them, we then accrue these costs. Okay? We then accrue these costs. Then we have what we call rent. Rent of shillings 48 million was paid on 1st October 2020, catering for 12 months. Now this is called prepaid. We have a prepaid rent here, because they're telling you rent of 48 million was paid on 1st October. Remember, 1st October is what? 1st October is just 3 months to the year end, because our year ends on 31st December 2020. So when we pay rent on 1st October 2020 means that we have 3 months to the year end. So if we are saying that rent of 48 million was paid on 1st October 2020, catering for 12 months, means that we paid for 3 months to the year end, and any balance was catering for 3 months. So here, for you to easily calculate this, is to get the 48 million and first divide it by 12 months to determine what is your monthly rent. When you get 48 and divide it by 12, gives you 3 million. So your monthly rent is 3 million. So if you paid 1st October 2020, you have October, November, and December. So 3 million times 3 basically relates to 2020. The rent for 3 months, which is 3 million times 3, relates to 2020, and any balance relates to the next financial year. So the balance, which is about 39 million, about 36. Okay. It's about 36 million. What's the other one is we're saying, okay, 48 divided by 12, that is a 4. Is it a 4 or 3? It's a 4. So it's 4 million. It's 4 million. So if you have 4 million times 3, that is actually give you 12 million. So 12 million is for the 3 months. 12 million is for the 3 months. And what remains is the other balance, the other, when you get the 12 million, remove it from 48 million, that gives you about 36 million. So 36 million is a prepaid rent. And we know very well that prepaid rents should not be included within our what? Within our statement of comprehensive income, because this is rent that relates to the next financial period. Okay. Yeah, that's very critical for us. And then we have non-current assets, which they are telling us that these are depreciated as follows. Now, the reason why they are giving us this information also as well, remember, in the statement, in the trial balance here, they gave us these assets. They also gave us accumulated depreciation, but this accumulated depreciation was as at 1st January 2020. So it was at the start of the year. So if they come here and they give us now non-current assets are depreciated as follows: motor vehicles, 12.5% on cost, means that this is going to help us to capture the depreciation for this year. Now, when they say 12.5% on cost, it's the same thing of you being told use straight line depreciation. Because we have two methods of depreciation that you're going to interface with on this journey: straight line depreciation and reducing balance method. So when they tell you motor vehicle 12.5 on cost, means that you're going to just get the 12.5 and subject it on cost. So you get 12.5 times the cost that we have, which is 115. The cost for the motor vehicle is 20,505,504. That is, I think, what we have right there. The same thing with computers. They also told you it is on cost. So you also get 25% times cost to give you the depreciation. And then we have plant and machinery, which they are saying plant and machinery is 20% reducing balance. So 20% reducing balance means we have to subject it to the net book value. Okay. We have to subject 20% on the reducing balance. So let's see here. This is our plant and machinery. Plant and machinery, the cost is what? The cost is 345. And the accumulated depreciation is what? 103,695. So if we want to get the net book value that we have subject our depreciation to be this 345,650, remove what? Remove 103,695. So what you get is the net book value that you come and multiply with your 20% here. That's why it is called reducing balance. So reducing balance like that, okay? Then we have, they're telling us that the loan was acquired on—
Excuse me, sir.
You're excused.
Kindly repeat for me the reducing balance method.
Okay. So we are saying that reducing balance, if it is straight line, we subject this value on cost. You get the 12.5% and multiply by what we have as the cost value here. The same thing we also do for computer. When it comes to plant and machinery that is on reducing balance, okay, the formula for us to calculate the depreciation for reducing balance. Depreciation is usually given by the percentage that you have times the net book value. And net book value, the net book value, net book value is given by cost minus accumulated depreciation. Is given by cost minus accumulated depreciation. So basically, your depreciation is the same thing as percentage times what? Times this whole thing. Okay. So in this case, if it's plant and machinery, okay, our depreciation will be the percentage. This is for plant and machinery. It will equal the percentage which we have from our records. We are given a percentage of 20%. So you get the 20% right there. Okay. So this is supposed to be multiplied. So we are going to multiply this 20% with what? With the cost at hand. Okay. And how do we determine the cost? Go back to your what? To your trial balance, get the cost, which is 345. Okay. So I'll just get my 345 there. I think that is the one that I have. 345,000. Okay. So then I should less what I have as my accumulated depreciation. So my accumulated depreciation for plant and machinery is 103,695. 103,695. 103,695. So that is how I get my what? So you calculate this and you're able to get your accumulated, you're able to get your depreciation for the period. This is between percentage. This should be a number. Should be able to get something like this from your calculator. You can press your calculator to confirm, but that is something that you're able to get. Okay. Yet for straight line, we just said we just get the value and subject it. We just get the cost here. We don't look for cost when we are doing depreciation on cost, which is straight line depreciation. We don't look at the accumulated depreciation. Okay, we don't look at the accumulated depreciation. We only look at the cost that we have at hand. Then we have now they are telling us here that the loan was acquired on 1st October 2020 and the interest was outstanding. So what does this mean to you? That this so-called loan you're seeing here, the 18% repayable by 2027, was acquired on which date? It was acquired on 1st October 2020, and they're telling us that interest was outstanding. So what this means is that we are supposed to calculate the interest for this year. But since this loan was acquired on 1st October 2020, we will calculate interest and get only interest for only 3 months that this loan existed. October, November, and December, 3 months. Okay. So our loan has an interest of 18% and it's worth 300,000. So if I'm trying to calculate my loan interest here, loan interest, it will be basically 18%. So it will be 18% times 300,000. So this is the annual interest. This is the annual interest. Then if I want interest for the month, okay, if I want interest for the month, it will be I'll get this because this is the full interest. Let me even get the answer here. 18% times 300,000. What do I get? So I get 54,000. So this is my interest for which period? For the 12 months. So if I want interest for the month, I'll get this divided by 12. So this is my monthly interest. So if I want to get interest for 3 months, this will be basically this times 3. So this is the interest that I'll recognize for the 3 months when it comes to the interest, when it comes to this loan, because this loan existed for 3 months. So that is the interest that I'll recognize, 13,500. Okay. So that is very important. That's what the examiner expected you to be able to do here. Yeah. Down here, as you can see. They went ahead also to tell you something and said sales include a deposit of 3 million cash received from a customer on 4th November. Sales include a deposit of 3 million cash received from a customer on 4th November 2020 for goods that were to be delivered on 14th February 2021. Sales include a deposit of 3 million cash received from a customer on 4th November 2020 for goods that were to be delivered on 14th February 2021. Now, the goods are to be delivered in a period that is beyond the year-end period. Remember, our end of year period ends 31st December. So any goods that are delivered, on 14th are basically goods that relate to the next financial year. So this deposit of 3 million cash that they are telling us that is included within our sales. So these sales that you're seeing up here, okay, they have not given us the sales, but you know the sales are already within the profit here. So the sales include 3 million cash. So this 3 million cash has to be excluded from your sales because it's a prepaid amount. Basically, okay, you may not call it prepaid, you may call it income received in advance because you have received this income in advance from your customer. And you can only recognize this sale after you have delivered, which delivery date is actually beyond the year-end period. So your delivery date is 14th February 2021. Okay, that's very important for you. So this, we needed to make that adjustment. And then we have the estimated tax for the year, which is 325. So businesses are taxed. So this is their estimated tax that they are provided us with. Now, this question, I want you to look critically. Remember, the question asked you to prepare the adjusted profit, the statement of changes in equity, and the statement of financial position. Now, most questions will ask you to prepare the statement of profit and loss. But in this case, the examiner was a bit different. He said that, let me give you the profit. And then I ask you for the adjusted profit. Let me give you the profit and then you calculate the adjusted profit. So for you to calculate the adjusted profit, you should know how to calculate the profit. For you to do the adjusted profit, you should actually know how to calculate the profit. Remember, I was trying to give you the format of how you calculate your profits here, okay? And I'd given you up to this level of where you have your cost of sales, okay? Because after you have your opening stock, then you add your purchases, you less purchase returns, add carriage inwards, get your net purchases and less closing stock. You then get your so-called what? Your so-called cost of sales, okay? So let's imagine this is here. show you something small. So you get your cost of sales. Which will be here. Now, when you get your sales, your net sales, and remove cost of sales, you then come to your gross profit or gross loss, depending on which one is higher than the other. Then from there, you have your additional income in case you have any. And some of the additional income we could have, as we have seen before, is that we can have interest income. If you have, for example, an investment, okay, at hand, and that investment gives you interest routinely, that would be interest income. So you can have interest as an income, you can have commission, you can have rental income, just in case as a business you have something that you rent out, and many other things that you can have. You can also have dividends income. If you own shares in another company as a business and you paid dividends at the end of the year, this could also be dividends income. So dividends are not only that it's only us that give dividends, we can also earn dividends as a company, just in case we have shares. And yes, companies are allowed to buy shares in other companies. And that's why you saw when MTN listed its shares, we saw that most of the shares were actually bought by NSSL, which is a company on its own. So companies can also buy shares in other companies. We can have that. Then you have your total income, which you can add to your gross profit, and then have your so-called gross income, okay? After you've looked at that, then after that, you now come to your other operating expenses. Other operating expenses. Now it is within your other operating expenses that you now have your rent, you now have your electricity, you have your transport expenses, and so on, okay? So this format should be really handy to you, and when you look at some of our previous videos, we still went through. I'm just trying to emphasize something small for you here. So we have, let's say, rent. We have electricity. We have maybe water bill. We have salaries, etc. So these are also expenses that you have. Okay. And then this will give you total expenses. Right there. And after the total expenses, you have your so-called net profit or loss. Right there. Or it can be loss like that. So this is a simplistic way of how to do your profit and loss, okay? I can try to reduce the size so we can see it there. So as you can see, this is your profit and loss. So what the examiner did is that they are giving you an insight and telling you that this was already calculated. But this was calculated without taking into consideration these other things. So they want you to calculate a new profit, basically to get an adjusted profit. So like I said, most questions will give you a trial balance and they'll ask you to prepare a profit and loss. So they will ask you to actually prepare this that you have done here. They will ask you to prepare this, but in this case, they didn't ask you to prepare this. So in this case, what do we exactly do? So I want you to look critically here as we proceed through this question. So in this case, since they have asked you for adjusted profit, what you basically do, you start with your title. This is Kilungi Limited, okay? So call it Kilungi Limited is adjusted profit for the year ended 31st December 2020. So you come here and say Kilungi Limited is adjusted profit as per, okay, let's call it just for the period ended 31st December 2020. So that is what we have, okay? That is what we basically have. So what you do with adjusted profit is that you start with balance or say profit as per trial balance. So you're trying to bring the profit that is existing right now because they want adjusted profit. So we have a profit that is existing that we have in our trial balance, which is 905. Okay, so we are also going to include, let's include amounts here. So these amounts are actually in thousands. Sorry, these amounts are in thousands. So that when you write here your so-called 905, they can easily know that's 905. So this is your balance. Now, as you calculate your because this is adjusted profit, you're going to have items you're going to less, and you're going to have items that you're going to add based on the effect. At the end of the day, you should be able to get to an adjusted profit for the year, for the period, okay? Supposed to end on an adjusted profit for the period that we are yet to find right there. So this is the profit. Now, in this case, the examiner expects you to look at each of the additional information provided to you and ask yourself, as this item happens, does it negatively affect my profit? Basically, will it increase my profit or it will reduce my profit? Because these items, as they have telling us here, they're telling us that the assistant accountant determined a net profit reflected the trial balance, but had not taken into consideration the following items. So your question is, if I take into consideration these items, will my profit increase or decrease? Okay. And like I said, you can only do this when you know how to draw up the normal P&L, when you can picture out what the account assistant exactly did, because they have not showed us the statement of profit and loss that the accountant did. They have rather just given us a single value, which is the profit. So your role is to figure out, to ask yourself now, inventory here was overcosted. Inventory, which was valued at 6.7, was okay, which had the value of reasonable value of 4.5, was valued at 6.7. So how does this affect my profit? Does it mean my profits were overstated because of this, or my profits were understated? So this is what you're supposed to do now for this item 1, okay, about inventory. So I'll just come here. Let's see. So we saw that our inventory somewhere, I think it was here. So this was the inventory, closing inventory that they were supposed to use, but they rather used this. They used a higher figure. So I'll come to my statement of P&L. This is the statement of P&L that I have in the mind. Okay, you don't need to draw this in the exam, but I want you to observe something very, very critically here. So when you look at our inventory here, closing inventory, when we are calculating our profit, is less from what? We less our closing inventory where we are calculating our cost of sales. And I want you to watch again more critically here. When we're doing our sales, I want us to say something. So if this is our sales, less net sales returns, we're able to get our net sales. And then we do our cost of sales, and then we get our gross profit. Now, this is the thing. The higher the cost of sales, the lower the profit. Because in calculating the profit, we get the net sales and subtract the cost of sales to determine the profit, the gross profit, which influences even the NDR, the profit that we close with. So the higher the profit, okay, the higher the cost of sales, the lower the profit. The higher the cost of sales, the lower the profit. So I hope that comes to you very clearly. Because it means that you're going to remove a higher value from your sales to determine your profit. So the higher the cost of sales, the lower the profit. But in determining our cost of sales, we determine it by getting opening stock, add the purchases, less closing stock for now. Opening stock, add the purchases, less closing stock. So the question I'm going to ask you, if you have your cost of sales, and this is how you calculate it, if your closing stock is high, how would that affect your profit? How would that affect your cost of sales? Your cost of sales are opening stock, add the purchases, less closing stock. So how does your closing stock affect your cost of sales? So let me ask, the higher the closing stock, is it the higher the cost of sales or the lower the cost of sales? The higher the closing stock, does it give us a higher cost of sales or it gives us a lower cost of sales? Can a volunteer unmute and try to tell me what they think? The higher the closing stock, does it give us a higher cost of sales? Okay, somebody says that the higher the cost of sales. So they are telling us that if our closing stock is high, our cost of sales will also be high. I think we need to, anyone to unmute as I try to put figures to this thing. So let's say we have, this is our cost of sales. Let's say we have 20,000 here. And maybe we have 10,000 here. Okay. That's what we have. And then we have maybe our net purchases. Let's say purchase returns is 2,000. Carriage inwards maybe 1,000. This to and then my net purchases, remember this is a subtraction. So my net purchases ideally will be, okay, sorry, this is one that my net purchases are here. My net purchases will be this, okay, will be that, minus this 2. So I'll just try to add this plus this cost, sorry, that has a negative. So my net purchases will be this value, okay? These are my net purchases. Then my closing stock is, let's say I closed with 8,000. This is what I closed with. We are going to demonstrate something, and I want you to be very attentive here. Make sure you switch off any distraction that is disturbing you. So this is my cost of sales. My cost of sales will be this, like we are saying, is opening stock plus purchases less closing stock. So my closing stock is 22. 8,000 here. So this is what I'm asking, and I want you again be attentive. If my closing stock increases, what will happen to my cost of sales? This is my cost of sales. So if my closing stock instead of 8,000 was supposed to be 10,000, you're going to see how do we see what is happening to my cost of sales? My cost of sales has gone down. If this gets to, let's say, 30,000, you see my cost of it has even gone to zero. Let me use a lower figure. Maybe it is 15,000. Let's say it is 15,000. So it's giving me still 15,000. Let me use another figure, maybe 17,000. So you can see that the more I'm increasing my closing stock, because we had 8,000 at the start, the more this figure keeps on reducing. So this is the principle. The higher the closing stock, the lower the cost of sales. The higher the closing stock, the lower cost of sales. So if I put a lower figure, for example, I put 5,000, you're going to see my cost of sales increasing. If I put 5,000, my cost of sales are going to go up. So this is what happens in real life. So the higher the closing stock, the lower the cost of sales. And the lower the closing stock, the higher the cost of sales. And how does that affect profit? So let's imagine this is my profit. Remember, I tried to put maybe profit in this column. Let's say this is my profit. Remember, what do we get profit from? Let me just think, let me also use dummy figures here. Maybe this was 100,000. And then this is, let's say, 5,000. And my net sales was this minus this, which is 95. So you're going to see something here. So my gross profit is this minus this, okay? So we are saying what happens to our profit when inventory is higher and what happens when it is lower. So because cost of sales influences the profit, because the higher the cost of sales, the lower the profit. Because profit is sales minus cost of sales. So if you're removing a higher value from your sales, means you're going to get a lower profit. So if we are saying that our closing inventory, if our closing inventory is high, means that we're going to have a lower cost of sales. That a lower cost of sales will reflect in a higher profit. Because a lower cost of sales means a lower amount subtracted from your sales and means you're going to get a higher profit. So the higher the closing stock, the higher the profit. And you're going to see it. For example, right now we have 5,000. When I add just this 5,000 and make it 10,000, you're going to see this increasing. You see, if I make this 10,000, you're going to see how this is going to change. This is going to come to 75. So your profit, as your inventory increases, your profit will increase. As we saw that as our cost of sales increases, as our cost of sales increases, it lowers our profit. If it's closing inventory, if closing inventory increases, it negatively affects our cost of sales, which will in a way positively affect our profit. Why am I labeling to explain this? Let's look at our question here. This question, they are asking us to calculate the adjusted profit. So our question here is to ask ourselves, this that they didn't take into consideration, how does it have an effect on our profit that we have at the start? So since we have 6.7 here and 4.5, and they recorded a lower figure or they used the higher figure compared to what they would have used. And we have already determined the difference, which is 2 points. We have a 2.2 here. 2.2 is the difference between what they used and what we should have used. It's basically the difference between this 45 as well and the 43 is a 2.2. So this means that our inventory is overcharged by 2.2. So our inventory right here has a 2.2 in it that is not supposed to be there. So what this means is that our profit is what? Is overstated. Okay? Our profit is, because just look at it. If, for example, maybe let me use, since it's a 2.2, let me just add 200. When I add 200 here, it's going to get to 77,200. So if there's a 2.2 included within my inventory, it is making me my profit increase. So ideally, if I have my so-called statement of adjusted profit, this 905, and I'm trying to adjust, and I want now to get the true value of my profit, I have to less the difference on closing inventory. Okay, due to recognition of how much? The 2.2. Because it is inflating my profit. This that they didn't take into consideration made my profit to be higher than it should have been. Remember what we are doing? We are calculating the adjusted profit. So that's why we are trying to picture and understand this that they didn't take into consideration here. What effect does it have on my profit? Okay, so we are saying that this 6.7 has that effect. Since we posted 6.7 instead of 4.5, the difference between 6.5 and 6.7 and 4.5, which is 2.2, is supposed to be removed from our profit because we overvalued our inventory, which brought a higher profit. As we have agreed that when you value your inventory, if you give a higher value of closing stock here, if you give a higher value of closing stock here, it will definitely increase your profit. It will increase your profit. And even we tried it, for example, if this was 15,000, you'll see that your profit will increase. The more you increase this value, the more it increases. So in case you record a wrong value of inventory by a higher value, then you should reduce your profit by the same value. Okay, you should reduce your profits by the same value. I hope you can pick something small. I think if you don't understand, then you can try to rewind back if you're watching a replay of this and try to listen to it again and see if you can picture it. But I believe you have. Let me just demonstrate when it comes to purchase returns, and you're going to see something happen here. So they're telling us that purchase returns of 4.5 to a credit supplier were not accounted for. So the next question I'm going to ask myself is, how do purchase returns affect my profits? How do purchase returns affect my profits? So I have purchase returns of 4.5, which they are telling me were not accounted for. So basically, they were not recorded. I want you to watch closely with me. So 4.5, let's call it 4,500, just in case these figures are in thousands. Okay, these figures are in thousands. So 4,500 is 4.5 is 4,500. So you look critically. your eyes should be on this figure and should also be on this figure. So I'm going to adjust here. So this is 10,000. In case they are telling me that my purchase returns of 4.5 were not accounted for, let's see account for them and see how this profit is going to change. So currently, let me just put here, currently we have a profit of 215. And let's say this is what that they accounted for in the purchase returns without accounting for the 4.5. Let's now account for the 4.5. So I'll come to the 10,000. Instead of 10,000, I'm going to add 4,500. So I'm going to add 4,500. This is the new profit that I'm going to get. My new profit is going to be how much? It's going to be 210,500. Let's get the difference between this and this. It's still 4,500. So you not recording purchase returns here, it will still affect your profits by the same margin. But this is what is happening. When you don't record purchase returns, what is happening to your profits? Your profits are 215. When you record the purchase returns, your profits go, they go low, they reduce. From 215, we now have 210. What does this mean? Means that the higher the purchase returns, the lower the profit. The higher the purchase returns, the lower the profit. So if you have any purchase returns that you have not accounted for, means that when you account for them, they will reduce your profits even lower. Your profits will even go more low. So if the question is giving us that within this question, we have a net profit of 905. And this 905 was gotten before taking into consideration these purchase returns. Your question should be that once I consider this 4.5, what will it affect my profits? It means that your profits will go low by the same value. So when I'm trying to prepare my adjustment in profit, which is my adjusted profit, I have to come here and recognize the purchase returns, okay? So the purchase returns are also going to be less purchase returns that were not recognized. And I'm going to less them by the value, which is 4,500. So I'm trying to explain this to help you understand why am I not adding the purchase returns, but I'm rather reducing. Because this is the profit I've started with, and every item that I record down here has to either increase or reduce my profit. And that decision is based on the effect such a transaction can have on your profits. Okay? It may seem confusing right now, but once you try to think this alone, you'll be able to picture it out a little more with the guidance of this recording, okay? Now, let's see something small here as well. So they're telling us interim dividends of 90. Okay, some says, let me just try to correct. I think I put purchases in the wrong way. Let me just try to correct that. They're saying that, okay, I put it in purchase returns. Oh, okay. Thank you so much. Let's correct this. Let's correct this. Let's correct this. Let's correct this. So let me put it here. So the previous purchase returns were 2,000, and now it is 4,500. Okay. It is now 4,500. So let's just try to see what that is. Just a moment. Let's first test this thing a little more so we can understand. So we have 215 as our profit before. Okay. before we have recognized the purchase returns, this is the profit, which is 215. That this is what we have. So now let's recognize the purchase returns, okay? Which is 4,500. So it means that if we have 2,000 here, it's now going to increase by 4,500, okay? So it's more of me adding 4,500. Noise changing. Just try to change my formulas. Just a little here. This is 4,500. 10, 10, 6.5. 5.5, 4.5. First wait, I try to see what I'm trying to do. My cost of sales. So let me try to adjust my cost of sales. So my cost of sales, instead of picking this purchases, let me pick the net purchases figure. So instead of this, let this Excel not disturb you much. You're not required to do this in exam. I'm just trying to use it for demonstration. So I'm going to use my. So it is, I'm doing opening stock, add purchases, which is my net purchases, then less closing stock. So this is what I happen to get, okay? Let me first try before. So before, okay, this is the true profit. So this is the profit. So this is the profit I have before. We want to retest the effect and see. And then we are going to now get our profit after. Maybe to also help you to figure this out on your own. So profit after. So the profit after, when we add the 4.5, okay? So what are we seeing here? The new profit is here. The profit we are getting is 220. So are we seeing that this is telling us that the more our purchase returns increase, the more our profits also increase. The higher the purchase returns, the higher the profits. Let's just try to study it a little more. When it comes to our cost of sales, let's first pick it from the aspect of cost of sales, okay? Because our cost of sales is opening stock, add purchases, and less closing stock. We're able to get our cost of sales. So what this means is that if our purchases are high, because our purchases are added on the opening stock and the less closing stock determine our cost of sales. So the higher the purchases, the higher the cost of sales. And the higher the cost of sales, the lower the profit. Okay, I repeat. The higher the purchases, the higher the cost of sales, and the lower profit. So if you have purchase returns that reduce your purchases, okay, means that your purchases are lower. So the lower the purchases, the lower cost of sales, and you know very well that when we're purchasing our profit, we do sales minus cost of sales. So if your cost of sales are low, means they'll give you a higher profit. So that is why we are seeing that we are getting our profit before, which is 216, okay? And then we are getting our profit after, which is 220. Okay. So what does this mean to our question? When you come here, okay, when you come to our question, the one we have at hand, where they are telling us that purchase returns are to the tune of how much? Just a moment. Purchase returns of 4.5 were not recorded. Your question to ask yourself here is, if these purchase returns were not recorded, what effect do they have on my net profit? If they were recorded, would they increase my profit or they would reduce my profit? Okay, so we have seen from the scenario at hand, okay, the scenario here, that the more we recognize our purchase returns, the more our profit increased. So even when it comes to this question, means that if we had recognized these purchase returns, I'm just trying to reiterate this because we had recorded it wrongly there. If we had recognized our purchase returns, the 4.5, means our profit would have been higher than 905, based on what we have done in the demonstration. So that means that when you're trying to make the adjustment for purchase returns, you will not do what we have done before, because we had taken a wrong figure. Instead of lessing, you're supposed to rather add the purchase returns, okay, of 4.5. Let me just try to hear from 1 to people if the explanation makes sense. From those that are following this live session, does this make sense to you? These two items, inventory and purchase returns, as we adjust, does it make sense to you? You can just say I understand, or I thought I don't understand. Just be honest with you. Do you understand what we are doing? Okay, Joanne says makes sense.
Yeah, it also makes sense.
It makes sense, eh? Okay.
I understand also.
Okay, fine. Thanks very much. I think at least I've gotten enough responses. You can use the chat box just in case you want to add. So it makes sense. And remember, the question was asking us to do the adjusted profit. So you have to understand, you have to have that picture behind on what was done and what effect will it have on whatever I'm doing. So they're telling us that interim dividends of shillings is reflected in the trial balance were paid on 3rd October 2020. Directors further proposed the final dividend of 70 per share on 28th December 2020, which is subject to a resolution at the annual general meeting in May 2021. I say that this will not have a big effect on our statement because it's yet to get a resolution in the next financial year. But then I said rather, this that was paid during the year has an effect on our financial statements. Now, dividends are not expenses and therefore should not be recorded in our statement of comprehensive income, and therefore they don't have any effect onto this profit. Well, they were calculating for this profit 905. This has no effect. Dividends are only recorded in the statement of changes in equity. We record dividends in the statement of changes in equity because they only affect your retained earnings. Remember, we pay dividends from our profits, so that is where we record them. Okay, so this will not affect our adjusted profits. I just want to move to this and maybe we're able to understand, appreciate, and then I can get you on the rest, and then we can close the session. It's getting a little late for us. So we have salaries and utilities. Maybe this could be last, and then once I've done the salaries and utilities, then you can easily think about this. So salaries and utilities, 12.5, and then 670 respectively were outstanding. Now I want to ask you a very small question here, and you're going to respond as well. So if these salaries and utilities were not considered, because this question was saying had not taken into consideration, and we are saying that when we have salaries of this kind that were not paid, that were outstanding, we are supposed to accrue for them. And I said that the double entry for accruing is we shall debit salaries and credit our accruals. So these salaries, what effect, if we recognize them, what effect will they have on our profits? Will our profits increase or they reduce? Could I just get a few responses? If we recognize,
the profit will reduce.
The profits will reduce, which I believe that if one of us agrees. So when you're doing your adjustment here, without us going into much details, you come and just say less outstanding salaries. You write the figure there, and then also you less the outstanding rent, because these are expenses, and if they were outstanding, I think it's utilities, not rent. And if they were outstanding, then they should actually reduce 0.5 and 670. This is utilities. So you come and adjust them by reducing them on your profit. Utilities. So this is 12,500, and this was 670. So that was as simple as it is, okay? And then the next thing we also have, they have also given us depreciation. So I already guided you now to calculate depreciation. Now the next question here, if we are going to recognize depreciation, will it increase our profits or reduce our profits? It will reduce our profits. Why? Because depreciation is an expense. So what you basically do is you just come and say depreciation. You come and say depreciation, and then you're able to record the depreciation for motor vehicle, depreciation for computer. As you less them, just substitute put the word less depreciation as you put the respective amounts that you would have gotten. I've already guided you on how to get the respective depreciation. So let's just look at this one as well. The loan that was acquired on that had an interest. We already calculated the interest for the 3 months. Your question should be, does this interest increase my profits or reduce my profits? Can I hear from somebody? Does the interest increase our profits or reduce our profits?
It reduces.
It reduces. So you just come here and say less interest. But remember, we only recognize the interest for the 3 months, which we calculated here. We calculated some interest for the 3 months. This is the only interest that we checked there, which is the 13,500, because that is the only interest that is valid to be recognized this year. And then lastly, when you come to this sale, okay, where they're telling us that sales include the 3 million cash received from a customer on 4th November for goods that were to be delivered on 14th February 2021. And we say that this sale is not related to this financial year, it relates to the next financial year. So what do we do with this sale? These sales, if we are excluding this 3 million because it's not a valid sale as of this year, will it increase our profits or to reduce our profits? Can I also get something from a volunteer? These sales that we are excluding, the sales worth 3 million, because they don't. If, for example, we had our so-called from the statement of comprehensive income. If, for example, this was 100,000, and I told you that, remember, if these figures, let's say, are in thousands, okay, just to assume, this one is not giving me. If these are in thousands, for demonstration purposes, okay, that one. Let's leave it. So let's assume these are in 1,000. So this is like 100 million. But then they tell you that part of this 100 million, 3 million relates to a customer that you're supposed to deliver to. So it means that your sales in one way or the other were supposed to be not at 100,000, but they were supposed to be at what? You're supposed to have 97 million. Your question should be, the more you reduce your sales, will it increase your profits or to reduce your profits? Can anyone support on that? Our sales, when they increase, they reduce our profits. When they reduce our profits, they increase our profits.
They reduce the profits.
Yes, they reduce our profits. So when that means that even when we are making an adjustment here, I'll just come here and say, less sales that relate to next financial year. Okay, relate to next financial year. So you're able to write them there and come and put the figure, which is let's say 3 million. So after you've added and subtracted whatever is supposed to be subtracted and added, you're now able to come to your now remaining figure that you have here. What basically should be your new profit. For example, if we were lessing this, I'll just put a negative for me here. We've not added other figures, so you're able to work out those. But I just want to demonstrate for you here. I think for this one we were adding, so I can leave it. This we are subtracting, and this we are also subtracting. So this comes to 877. After you've taken into consideration depreciation to even reduce more. So this is our adjusted profit, and it is adjusting from 905, which we originally had. So we can see the importance and what the examiner expected of us to do. Sorry that we had to take a little longer on the first items because I was trying to demonstrate to you, but now that you understand, you can easily be able to rethink through. Okay, so that is one thing that you needed to basically be able to do. So this question later on was asking you to draw up a statement of changes in equity and also required you to do a statement of financial position. Before you do statement of changes in equity and statement of financial position, you should have gone through the video that takes you through the different formats of the different documents. And as you remember, within these notes, which you should have, these notes, which is topic 3, we have formats for each of these financial statements. For example, this is the balance sheet. And we also had, I think, the format. This is the presentation for the balance sheet, which is statement of financial position. We also had the format for statement of changes in equity. I think it is down. This is a statement of changes in equity. This is comprehensive income. This is statement of changes. So this was the format. This was a statement of changes in equity format. So you should be able to know how to do. Remember, for statement of changes in equity, these columns vary depending on the question. Now, for example, this question we have share capital. Then you should also have a column for share premium. You should also have a column for the revaluation reserves, and you should also have a column for retained earnings, which in this case they are calling retained profits. So you should know this format, and you're able to bring in here. Usually we start with the balances as at a start, and then we're able to add, but you try out that on your own because of the time, and then you can see later on what to do. And after you have done that, they ask you to prepare the statement of financial position, which you can use this information. Like I told you, trade payables, those are current liabilities. Investments, these are included as non-current assets. Allowance for bad debts, these are deducted from your trade receivables. So you're able to use this information with the adjustments that you have at hand here. Just in case there's an adjustment that you have made here that affects the statement of financial position, then you take into consideration it. For example, while you calculated your depreciation for the year, you have to get the new values of your accumulated depreciation. As this was accumulated depreciation as at 1st January 2020, you should get again additional. You should add on this the depreciation for the year to get the accumulated depreciation as at 31st December 2020. And this accumulated depreciation you have gotten, is one that you remove from the cost of your assets, get the net book value of your assets that you're going to recognize within your statement of financial position. So we'll look at other numbers that will give us an insight onto how to prepare a statement of financial position and also statement of changes in equity. Then you can be able to do this on your own. Okay. So thank you so much for being here, for being patient, and I look forward to having you as part of the next session.